Okay. All right, so I'm going to be introducing Eric Becker from Clean Yield Asset Management. Eric manages client portfolios and oversees the firm's investment and portfolio management discipline. Eric has been engaged in social and environmental investing since 1993. He joined Clean Yield in 2009 after 16 years as an equity analyst and portfolio manager for Trillium Asset Management in Boston. Eric is a founding member of the Slow Money movement and co-founded Slow Money Boston and Slow Money Vermont, which seek to connect investors and entrepreneurs in the service of building a healthier and more robust food system. Eric serves as a trustee of Sterling College in Craftsbury Common, Vermont. Previously, he was a board member of the Carrot Project and senior fellow of the Environmental Leadership Program. Eric holds a BA in comparative religion from Haverford College and earned the Chartered Financial Analyst designation from the CFA Institute. Eric and his two children live in Stafford, Vermont, where Eric enjoys beekeeping, birding, and listening to live music.
I need to update that.
Okay, go ahead and update that, Eric.
I no longer live in Stratford, Vermont.
Okay.
In St. George, Vermont now, but otherwise Vermont. It's pretty much on.
Okay, duly noted. All right, so Eric, if you want to start screen sharing, we can get right into your presentation.
Okay, let's see if this works. Here we go. And now, how's that look? Full screen?
Very good.
Okay, great. So thank you for having me. I understand that you had a presentation a couple weeks ago from an organizer of the Harvard University divestment movement. And if you haven't heard the news, the university announced last week that it was effectively divesting from fossil fuels in the coming years, which is another watershed moment for the fossil fuel divestment movement. So very exciting, and it's good timing that you had a presentation about it so recently. I'm going to focus more on divestment of fossil fuels for individuals, but talk a little bit about the broader movement as well. And I want to make it clear that, in my view, the fossil fuel divestment movement has already been a stunning success. When Bill McKibben launched, well, inspired by students at Swarthmore College, actually, Bill McKibben came out with an article in 2012, the Do the Math article in Rolling Stone magazine, and called for divestment of fossil fuels from institutional and individual portfolios. And at that point, it seemed like kind of a shouting into the abyss or something, but it has been a really successful movement with trillions of dollars moving out of fossil fuels and many, many institutions participating. In addition to that growth of the movement, it's been a great investment strategy, as fossil fuel companies have lagged the overall financial market, stock market dramatically, which I'll show you in a minute. And as the movement grew, the offerings available to investors of fossil fuel free funds and investment managers has grown, making it easier and easier to divest and still have a healthy, well-balanced portfolio. So the success that I mentioned has been hand in hand with the broader climate movement. Direct action against fossil fuel infrastructure has played a really important role, and as well as advocacy through government action and campaigns. But all of these combined have succeeded in raising awareness that the end of the fossil fuel age is at hand, and that has forced Wall Street and other financial regulators and investors to reckon with the risks of continuing to invest in fossil fuel companies. And as investors And I said many banks, I should say some banks have stepped away from financing fossil fuel companies. That has increased the cost of capital for these companies, meaning that the interest rate they have to pay is higher if they're going to borrow money, if they're trying to sell stock to fund their developments, the price of their stock is depressed. And so it's made it harder for fossil fuel companies to explore for new sources of fossil fuels and to produce the known resources, and to move it around. So it's really changed the landscape. It's also spurred investors to who are pulling their money out of fossil fuels to look for clean energy opportunities, because that's clearly where the growth is going to be going forward. And that means that those companies have a lower cost of capital as funds flow in that direction. It makes it easier for clean energy firms to raise money and do the research and development and deploy the technologies that are already there. So this slide is a graphic illustration of the divergence between the overall stock market as represented by the white line, which is the S&P 500, and the yellow line is the S&P energy sector. And when S&P talks about energy, they are talking about fossil fuels. All the clean energy companies are considered technology companies at this point. But these are the oil and gas companies, for the most part, some coal, but very little. And this goes back to July 1st of 2012, about the time that Bill McKibben's article came out in Rolling Stone. And you can see for the first 2 years through the middle of 2014, energy companies and the stock market were tracking very, very closely. And then you had a huge shift occur, and energy companies have been in a death spiral since that time, essentially, while the stock market has roared to new heights. So overall, if you'd invested your money in the S&P 500 in 2012, you would have gained 229%. If you put it in the energy sector, it would be down 28% over practically a decade. So this is a real trend and doesn't show any signs of reversing, and I don't think it will. The challenge for individual investors is many have their funds in index funds or other passive investment vehicles, and most of those indexes have significant exposure to fossil fuels. So this is a graphic of the ratings put together by a foundation called the As You Sow Foundation that has developed some excellent tools around divestment, showing the relative rankings of these various indexes, stock indexes, and their exposure to fossil fuels. All of them are poorly to pretty poorly rated overall. The good news is that there are a growing number of fossil fuel free options for individual investors as well as institutions. And fossilfreefunds.org has an excellent search engine. I just screenshotted a couple pages worth of the list of fossil fuel free funds, but there's a broad array at this point. So I'm here to, in part, to urge you as individuals and families or folks who may be on the boards of organizations to take the next step. And that starts with knowing what you own. There are tools on fossilfreefunds.org where you can punch in any mutual fund or exchange traded fund that may be in your portfolio and see what its exposure is to fossil fuels. It's actually a remarkably powerful tool to understand what your existing exposure is if you haven't divested. If you manage your own funds, it also shows other options that are fossil fuel free, as well as the U.S. Social Investment Forum, SSAFE.org, has a list of socially responsible mutual funds, many of which are fossil fuel free. If you are working already with an investment advisor, they should be learning about fossil fuel free investing and getting over the mythology that you have to give up returns if you want to get out of fossil fuels. In fact, the reverse has been true, as I showed in that earlier slide. It's been a great investment decision to get out of fossil fuels. But many advisors were trained that you're going to hurt your returns if you do any type of social investing, which is wrong. But if they're receptive to to working with you to divest from fossil fuels, that's great. If not, I think it's worth looking for a new relationship, because there are plenty of advisors now who are open to this and have knowledge of how to do this responsibly, financially responsibly, as well as socially responsibly. And then the other piece of it is that all of us have relationships with banking institutions. Many of us have both savings and checking accounts, as well as credit cards with the big banks, Bank of America, Citibank, Chase, Wells Fargo, which continue to fund fossil fuel companies. And there are other options. So I mentioned a local bank in the Upper Valley, Hanover area, but there's actually a bank with a national, at least a credit card footprint nationally, called Amalgamated, which is grew out of the union textile unions in New York 80 years ago or something. But they are a very progressive bank, offer credit cards and other banking services, and that's another one to take a look at in terms of shifting your money out of the big banks. So that's a quick pitch to you about divestment. Here are some of the resources. These slides will be available through Michelle, so you don't have to scribble down the links. But these are some good resources, and I put Clean Yield's website there as well. Clean Yield manages funds for high net worth individuals and families, starting with a $1 million account size. And everything we do is fossil fuel free. We've been at it for about 35 years. And if anybody has any questions about Clean Yield, happy to answer that as well. So with that, I'd love to open it up. Questions?
Okay, let's see. Can we, Eric, can you
yeah, I gotta stop. That's what I was gonna try to do. I'm trying to get back to it. How do I get back to it? Stop share. There we go.
There we go. There we go. All right. So I'm going to put everyone back on gallery view, and it looks like Ted has a question.
Yeah, you characterized, Eric, the Harvard divestment as a watershed moment. Do you have any metrics that actually show that? Did the stock prices for fossil fuel companies, for example, dip in any significant way a day or 2 days after the Harvard announcement?
I haven't actually looked at that at stock price movements. I doubt it. I think of it as a watershed movement in terms of what's Yale going to do? What are the other big institutions, educational institutions, going to do now that Harvard has made this move? I think it's more of an issue of credibility than of financial impact in the short term. It's going to take them years to effectively divest. But the fact that they're moving this direction gives just even more credibility to the notion that fossil fuels are on the way out.
One more question, if you would.
Sure.
Why, from your armchair, doing what you do you have any explanation for why energy companies, fossil fuel companies, haven't moved, and the banks that back them haven't moved more quickly, investing many billions, if not trillions more dollars in green energy than they have?
Yeah, well, I think part of it comes back to what I mentioned about how the standard S&P classifies clean energy companies as technology and oil and gas as energy, that these companies, their DNA is in drilling holes in the ground and sucking out the fuel and processing it and distributing it. The clean energy business is a really, really different business. And I think that they don't understand it. I think a lot of them have been in denial about how fast the world is changing and how fast it's going to get off fossil fuels. And when they look at their financial model about what their business model is, it's a really different business that they're unfamiliar with, that they don't have the expertise in. And so I think that's why they haven't transitioned. I mean, you've had Shell and BP dabble in these areas in years past and then get out of it and come back to it in terms of solar and things like that. They never really got in with both feet, in part because in some ways they were too early when they did it back in the 90s when solar was much more expensive and the cost differentials were so great. But now that there are real businesses making real money in this space, I wouldn't be surprised over the next decade to see the oil companies now, out of desperation, begin to try to transition more aggressively. But it's going to be challenging because they don't have the the know-how to do it, and they don't have the talent. And I don't know that the young engineers who are working in clean energy are going to want to go work for ExxonMobil's new renewable energy division versus a more of a aggressive growth company.
Bob?
Yeah, I noticed, I wanted to get your comments on the glide path to divestiture. So once you make the decision as an individual or as an institution, how aggressively do you attempt to make that transition? So for example, in the case of Harvard, I noticed in their press release, they essentially are saying they're going to phase out of petrochemical companies over a period of years. Now, other things I've read indicate, you can take a sharper path towards divestiture. What are the pros and cons of taking different glide paths towards divestiture?
Yeah, I mean, I think it's much easier for an individual to just cut the cord and do it. I think an institution like Harvard or other large institutions who have many investment managers, they're so diversified, they own everything through multiple investment vehicles. It is more challenging because they need to work with their existing managers to shift or switch managers, and there's a whole administrative process to do that. So I understand the reluctance for them to set very short-term targets. It's a big ship to turn. So I think the sooner you get out, the better. Oil prices have rebounded dramatically from the lows of early in the pandemic, and so the oil and gas companies are doing okay right now. But I don't think that that's going to last, and so I think it's an opportunity to get out before things get worse for those companies.
Thank you.
Yep.
Mike?
Yeah, thanks, Eric. That was a great, if short, presentation, which we appreciate. So to get at what Bob is suggesting, it seems that there are impediments for individuals in transitioning their own portfolios that their financial advisors can help with. I mean, if they own Exxon stock, that's a pretty easy thing to sell and buy something more reasonable. But the more difficult part is if you own mutual funds that have accrued a lot of capital gains over the years. So, they make us look quite rich, but if selling those also comes at some significant cost. So in those cases, what's your advice about how to transition those kinds of funds into ESG?
Yeah, that can be really challenging. That's something that we experience a lot when new clients come to us and they have some old low cost basis stock or mutual funds where the tax implications of just a quick transition would be very burdensome. So we do have to work within those constraints. Depending on your level of resources, combining divestment with philanthropy can be very helpful. In other words, you can actually give away some of that stock or some of those mutual funds to 350.org or some other nonprofit where you're avoiding ever having to incur that gain, and that gift, that charitable gift, offsets some of the capital gains that you're taking to actually do the divestment. So that's not a perfect answer. It depends on a person's individual circumstances and tax rate. I would say that clearly a tax hike is coming at some point on capital gains. I mean, whether it passes, we'll see. I think it's likely that we get some sort of capital gain rate. So it's actually maybe advantageous to do that sooner rather than later. Do it in 2021 versus 2022 when you may have a higher capital gains rate. But it is a challenge. There's no, it's not everybody can just pull the plug on all of these stocks or mutual funds right away.
Right. And one, well, I'll let Gary have the final word here. Did you have a question, Gary?
I did. It's a lengthy one too. But basically, Eric, as I've been reading about this, and particularly the Harvard situation, there's been this dialogue back and forth. Is it better to get out of these companies totally or stay there where you have a voice on the board to change the direction of them? I mean, that has very little to do with us as individual investors. We don't have the voice in anything, but some of these big investors do. And I kind of have a story to tell about that too. I think it's relevant enough that I'll take the time. Delaney probably remembers our older son, Alec, who graduated from Wilmington Friends. He went into law, and I oftentimes say he went to the dark side. And he ended up working for this law firm an international law firm out of New York called White & Case. It's a huge firm, like 4,000 lawyers in it. And he ended up basically migrating to Saudi Arabia. Now, and the reason that White & Case is in Saudi Arabia is they've been the primary law firm for Aramco, this gigantic oil company. And I just, when he told me he was going there, I just sort of had a knot in the pit of my stomach, He went to the darkest of the dark side. And what has happened, he's recently gotten involved with a new project. They're building a new city called Neom up in northwest Saudi Arabia. And their goal up there, and this is Aramco money, dictated by the prince over there, which, has all sorts of complications about princes versus democracies, but they've decided they're going to create green hydrogen. And they're doing that by putting huge solar fields and huge wind farms there and doing electrolysis on the water to generate hydrogen with virtually no carbon base to that energy project. Then combining it with nitrogen to make ammonia, which can be then chilled and compressed and sent anywhere in the world where they strip the nitrogen off and they have hydrogen, which has basically been made. It's not like the dirty hydrogen we have in this country made from methane, but truly kind of a clean hydrogen. Now, it's sort of a back-assed way to get into this sort of thing, but nevertheless, it's been an example of going with fundamentally evil people and doing good things. And I wonder if that has any metaphor for the investment world about dealing with oil and other energy companies. Long story.
Yeah, no, I think it's there is a legitimate case to be made that having voices in the boardroom is really important. And the question is this like tobacco, where there's no real pivot to something better, or are these companies really going to make that dramatic change? And that remains to be seen. I think the battle at ExxonMobil with Engine One, which won 2 board seats, is I mean, that was another, watershed moment saying, investors are no longer going to just defer to the management of these companies as far as it goes on climate change. So I think there is a case to be made that having some ownership of these companies can be helpful. But I see both sides of it, that, we just need to get off of it, and that's, pull the funding from it. And can we help steer these large ships in the right direction? So I don't know what the right answer is, but
You're
but
supposed to give me the direct answers for that, Eric.
I think Ted has the answer.
it's complicated.
You're on mute, Ted.
You're muted, Ted.
The answer for the moment may be in an article that appeared in the Times either yesterday or the day before. And it directly addresses Gary's question. Is it better to have a seat on the board or to divest? And in the article, CalPERS was brought into play. That's the huge California University pension fund.
Yeah.
Yeah. And the head of CalPERS, or some principal officer in CalPERS, was saying, yeah, we think it's better to be on the boards and influence things that way. And the response from McGibbon and other environmental activists was that there's almost no evidence in the recent past, we're talking 10 or 15 years, that boards have done anything to shift companies like ExxonMobil or investors like CalPERS away from fossil fuel companies. You could counter argue that, well, it's too soon to say whether new membership on boards has no impact, because we've only very, very recently seen evidence, ExxonMobil is Exhibit A, that there is new board membership that might push things along. I think the basic problem, though, is that it just takes too long to shift the membership of the boards who might play an important part. And what we're up against is the ever greater urgency of urgency. And in terms of not waiting, it seems to me that divestment individually, institutionally, is the way to go.
Ted, we've been having an interesting conversation here at Longwood with some of the powers that be of our resident association. And we had a discussion about, are we headed towards evolution or revolution? And I tend to be much more on the revolution side. This person's much more on the evolution side. And I think those are the two sides of this argument we're talking about. Is it possible for these big institutions to evolve quickly enough that it's good to stay attached to them to guide that evolution? Or is it just time to say, chuck them all in the water, turn the refineries in this country to jungle gyms for the local kids and shut it all down? It's a challenging question. It really is.
True.
Do you see, Eric, any the issue of stranded assets in fossil fuel companies, given the slow pace with which they're moving to address climate change? It would seem that stranded assets become an increasing possibility. What's your take on it at the moment?
Yeah, absolutely. I believe the stranded asset story is real, and it's being understood better by Wall Street and by regulators. There was news yesterday about proposed disclosure requirements by the Securities and Exchange Commission for regular corporate reporting in the 10K or 10Q, the quarterly and annual reports they have to file, about all sorts of climate metrics. And I don't know if stranded assets is specified. I mean, not stranded assets, but the likelihood that assets will never be used will be reflected in there. But I think this sort of increasing disclosure requirements will expose that more. And I think there's big, big money at stake in terms of understanding the viability of these companies. And to me, they look like they're in a death spiral, but others will argue otherwise.
Okay, we've definitely taken more than our 5 minutes of Q&A, although they've been excellent questions and you've been a good resource for us, Eric. So
Really?
I'm going to follow up with this group with the resources that you shared and your contact information. And